Joining us now, we have Michael Yoshikami, CEO and founder of YCMNet Advisors, which manages over $1 billion in assets. And Michael joins us from Berkley, California. Mike, I guess my first question to you is any reaction to this passage of this House vote?
I'm not surprised after last night's agreement. And frankly, I wasn't surprised that they came to an agreement. I just didn't think any one of the parties, either of the parties, would want to be labeled as the party that pushed the United States to default. But I think the important issue here, Susan, is it's not so much what's happening with the deficit. What really matters, that's just noise. What really actually matters is the health of the economy. And that's why the market struggled today, despite global markets rising. The manufacturing numbers were weak. GDP has been revised downwards. So we are, in fact, seeing the U.S. economy struggling. Even though it is advanced forward, it is struggling.
That's right. The euphoria on Wall Street maybe lasted 30 seconds before we got into reality as to how weak and anemic the U.S. economy is, because you mentioned we had that downgrade, that revision downwards of Q1 GDP. Manufacturing, as you said, at its lowest in 2 years. We're close to contraction there. But then you also have the House, basically bipartisan politics, passing in these budget cuts. Is this the right strategy from governments?
Well, on the long term, it is the right strategy. I mean, a government is not going to be successful, an economy is not going to be successful with high deficits. It leads to a lower standard of living. So on the long term, it's a positive. But here's what it really means on the short term, Susan. It means that U.S. GDP is going to be slower than many people expect. It's a deleverage effect, just like what's happened with individuals, just like what's happened with businesses. Now the government is delevering. And when you have deleveraging, it means less spending, higher unemployment, slower growth. So we need to ratchet down our expectations, which we have already done, ratchet down expectations in terms of what U.S. GDP growth is going to look like.
Okay, and I guess for the naysayers, some are saying with, the spending being cut from the government, that in some way is basically tightening from the government at this point. What do you think?
Well, yeah, I mean, in a sense, that's what delevering is. I mean, the government is essentially tightening its belt, which essentially means what? There's going to be less money spent by the government, less money in circulation. So the reality is however you describe it, the government is cutting back, and it's going to slow economic growth.
It is going to slow economic growth. So what does that mean for the non-farm payrolls this Friday? Is that the end-all and the be-all for this week in terms of economic numbers?
Yeah, I think it's going to all come down to the jobs market. I think the housing numbers, people have been gravitating towards looking at housing starts. I would forget that. Those are all fictitious numbers at this point, in my view. The housing market is still very, very difficult in the United States, the real estate market. I think it's really about jobs. I mean, the economy is going to start growing when job growth starts growing. And we're seeing mixed numbers on the job market. So if job market starts to improve, then you're going to see the sentiment turn the other way.
Yeah, there's a lot of caution right now about sentiment, because with this House passage of this, $2.4 trillion package, all in terms of budget cuts over the next 10 years, we still have Standard & Poor's and the ratings agencies saying, well, we're going to take another look at this AAA rating. Do you think the markets have priced it in already?
Yeah, I think the markets have priced it in. In fact, if you look at yields in Asia on treasuries, yields actually went down. Because people were concerned the risk trade was coming off a bit. And so I think it is already priced in, and I think it's probably, in my view, a better than 50% chance that the rating agencies, despite what's happening in terms of deficit-cutting measures, still down with the United States, or at the very least put the United States on credit watch, in my view, as they should. I mean, in the end, talk is cheap. We need to see what deficit-cutting action really takes place with this first cut, and then after that, what's the subsequent plan to finally get U.S. government spending under control?
Michael, all in all, from what you've said so far, it doesn't seem to be a rosy picture for investors, but yet you expect a year-end rally. What are you seeing?
Well, see, here's the thing. I don't think the economy is terribly rosy. I call it a stumbling recovery. But from an equity market standpoint, U.S. companies are actually getting healthier. They have higher earnings numbers. Earnings have been very, very good this last quarter. I expect them to be good next quarter. Oil prices have come down from the $115, $120 a barrel. Even though there's not as many consumers buying products, companies are getting more healthy. They're getting healthier because they have less employees. They're running more efficiently, and that's what drives stock market growth. The real problem is going to be next year, once we already have wound out all of the earnings growth, now we have to start growing the top line. And the only way the top line, in terms of gross sales, actually starts increasing, your gross revenue starts increasing, is if we have a healthy job market, a healthy consumer market. U.S. economy is 70% consumption. That's going to be the tough part next year.
All right, Michael, thanks for joining us this morning. Michael Yoshikami, CEO and founder of YCMNet Advisors.